Look, I need you to pay very close attention to what I'm about to tell you, because what's happening in the silver market right now is something most people won't see coming until it's too late. And by then, the opportunity will have already passed them by. Right now, as I'm recording this, silver is sitting at a critical inflection point. We're talking about a setup that only happens once every decade or so. The kind of setup that, if you understand what's really going on beneath the surface, could represent one of the most significant wealth-building opportunities of the next several years. But here's the thing. Most investors are completely blind to it. They're watching gold hit new all-time highs, they're seeing Bitcoin make headlines, and they're completely missing what's brewing in silver. And that's exactly what makes this so powerful. Let me show you what I mean. Silver just broke through a resistance level that it's been testing for the better part of 3 years. We're talking about the $32 level that's acted as a ceiling since 2021. Every time silver approached this level, it got smacked down. Every single time. Until now. On November 8th, 2025, silver didn't just touch $32. It blew through it with conviction, closing at $33.47. And here's what most people don't understand about technical breakouts like this. When a metal tests a resistance level multiple times over years and finally breaks through, it's not just a chart pattern. It's a signal that the fundamental forces holding it down have finally been overwhelmed. Think about what that means. For 3 years, every time silver tried to rally, there was enough selling pressure to push it back down, enough paper contracts being dumped on the COMEX to kill the momentum, enough skepticism in the market to prevent a sustained move higher. But something changed. The selling pressure that's been capping this market for years just got overpowered. Now, I want you to understand something crucial here. Silver isn't just another commodity. It's not like copper or aluminum or even platinum. Silver occupies this unique space in the financial world where it's both an industrial metal and a monetary metal. And that dual nature is about to become incredibly important. On the industrial side, silver is absolutely critical to the green energy transition that's accelerating around the world. Every solar panel requires about 20 grams of silver. Electric vehicles use 2 to 3 times more silver than traditional cars. 5G infrastructure, which is being rolled out globally, is massively silver intensive. We're talking about a structural demand story that's only getting stronger. But here's where it gets really interesting. The solar industry alone is projected to consume over 200 million ounces of silver in 2025. That's nearly 20% of total global silver supply. And that number is expected to grow to 300 million ounces by 2030. Think about that for a second. One industry is going to consume a fifth of all the silver mined in the world this year. Meanwhile, on the monetary side, something fascinating is happening. Central banks around the world have been accumulating gold at record pace. We saw that story play out over the last 2 years. But what most people missed is that silver has historically followed gold's major moves with a lag. And when silver catches up, it doesn't just match gold's percentage gains, it amplifies them. Let me give you a historical example that's incredibly relevant right now. In 2010, gold was trading around $1,200 an ounce. Silver was at $18. Over the next year, gold rallied to $1,900, a gain of about 58%. Impressive, right? But silver went from $18 to $49. That's a 172% gain. Silver didn't just follow gold, it exploded. Why does this happen? It comes down to something called the gold-silver ratio. This ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, that ratio is sitting around 84 to 1. Historically, the average is closer to 60 to 1. And during precious metals bull markets, that ratio has compressed all the way down to 30 to 1 or even lower. What does that mean in practical terms? It means that if gold continues its current trajectory and the gold-silver ratio reverts to its historical average, silver has to move significantly higher just to maintain that relationship. We're not talking about a 10% or 20% move. We're talking about a potential doubling or tripling from current levels. But there's something even more compelling happening right now that most investors are completely unaware of. The physical silver market is showing signs of serious stress. And I'm not talking about some conspiracy theory or internet rumor. I'm talking about verifiable data from the exchanges and mints themselves. The U.S. Mint reported in October 2025 that Silver Eagle sales were up 47% year over year. The Royal Canadian Mint is experiencing similar demand surges. Premiums on physical silver coins and bars have been climbing steadily. In some markets, you're paying $4 to $6 over spot price just to get your hands on physical metal. That's a premium of 12% to 18%. Now, why would premiums be spiking if there's plenty of silver available? They wouldn't. What you're seeing is the early stages of a physical shortage developing while the paper price is still being suppressed by futures trading on the COMEX. This disconnect between physical and paper markets is exactly what happened before silver's explosive move in 2011. Let me paint you a picture of what's happening behind the scenes. The COMEX, which is the primary exchange where silver futures are traded, has been showing declining warehouse stocks. We're talking about a 15% decline in registered silver inventory over the past 6 months. Registered inventory is the silver that's actually available for delivery against futures contracts. At the same time, open interest in silver futures has been climbing. More contracts are being written while the amount of physical silver backing those contracts is shrinking. It's like a game of musical chairs, where they keep adding players but removing chairs. Eventually, the music stops, and there aren't enough chairs to go around. And here's where this gets really interesting from a geopolitical perspective. China has been quietly accumulating silver for years, not through official central bank purchases that get reported, but through private sector buying and strategic stockpiling. Chinese solar manufacturers are locking in long-term silver supplies. Chinese investors are buying physical silver as a hedge against their own currency concerns. India, the world's second-largest silver consumer, just reduced import duties on silver in July 2025. That immediately triggered a surge in imports. We're talking about a country of 1.4 billion people where silver has deep cultural significance, and the government just made it cheaper to import. What do you think that does to global supply dynamics? Meanwhile, on the supply side, we've got a problem that nobody's really talking about. Silver isn't primarily mined as a standalone metal. About 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. So silver supply is largely dependent on the economics of mining these other metals. Here's the issue. Many of these base metal mines are facing rising costs, permitting challenges and declining ore grades. Several major silver-producing mines in Mexico and Peru have faced operational disruptions over the past year. When you combine constrained supply with surging demand, you get a recipe for a significant price move. But let me tell you about something that happened in 1979 that's eerily similar to what we're seeing today. Back then, silver was trading around $6 an ounce. The Hunt brothers started accumulating massive amounts of physical silver, believing it was undervalued. As word spread and other investors piled in, silver went from $6 to $50 in less than a year. Now, I'm not saying we're going to see that kind of move. The market is different today, but the underlying dynamics are remarkably similar. You've got a metal that's essential for industrial use, that has monetary properties, that's in a supply deficit, and that's breaking out technically after years of consolidation. And here's something that should really get your attention. The silver mining industry is not in a position to rapidly increase supply. It takes 7 to 10 years to bring a new mine online from discovery to production. The lack of investment in new silver exploration over the past decade means there's no cavalry coming to rescue the supply situation. First, Majestic Silver, one of the largest primary silver producers, reported in their third quarter 2025 earnings that their all-in sustaining costs were $23.50 per ounce. Think about that. It costs them $23.50 to pull an ounce of silver out of the ground, process it, and bring it to market. With silver at $33, that's a healthy margin. But it also tells you there's a floor under this market. Silver is not going back to $15 or $18. The economics don't support it. Now let me shift gears for a moment and talk about something that's relevant if you're thinking about your retirement security. If you're sitting on $100,000 or more in traditional retirement accounts, I put together a comprehensive guide on how gold IRAs work. It's completely free, and you'll find it in the description below. It covers how you can get physical precious metals into your retirement account without triggering tax penalties. Worth checking out if that's relevant to your situation. All right, back to what's happening in the silver market right now. Because there's another layer to this story that ties into the broader monetary system, and it's something you need to understand. The US dollar has been the world's reserve currency since the end of World War II, but that dominance is being challenged in ways we haven't seen in generations. The BRICS nations, Brazil, Russia, India, China, and South Africa, have been actively working to reduce their dependence on the dollar. They've been settling trade in their own currencies, establishing alternative payment systems, and yes, accumulating gold and silver. In August 2025, the BRICS Summit in Johannesburg announced plans for a commodity-backed trade settlement system. While the details are still being worked out, the implication is clear. These countries, which represent about 40% of the world's population and a growing share of global GDP, are building infrastructure that reduces dollar dependence. What does this have to do with silver? Everything. Because as confidence in fiat currencies erodes, even gradually, investors and nations look for alternatives. Gold is the obvious choice, and we've seen that play out. But silver, with its lower price point and dual industrial monetary nature, becomes incredibly attractive as a store of value. Think about it from a practical standpoint. If you're a middle-class investor in India or China or Brazil, gold at $2,700 an ounce is expensive, but silver at $33 an ounce is accessible. You can accumulate meaningful amounts of silver without needing massive capital. And as more people around the world come to this realization, the demand dynamics shift dramatically. There's also something happening in the investment world that's creating a perfect storm for silver. The rise of ESG investing, environmental, social, and governance, has pushed massive amounts of capital into green energy companies. But here's what most ESG investors don't realize. You can't have a green energy transition without silver. It's physically impossible. Every wind turbine, every solar panel, every electric vehicle, every 5G tower, they all require silver. So when pension funds and institutional investors pour hundreds of billions into ESG mandates, they're indirectly creating enormous demand for silver. But they're not connecting those dots yet. When they do, when the investment community fully grasps that silver is the linchpin of the entire green energy transition, that's when things get really interesting. Let me give you some specific numbers to illustrate this. The International Energy Agency projects that solar capacity needs to triple by 2030 to meet climate goals. Triple. If solar capacity triples, and each megawatt of solar capacity requires roughly 330 ounces of silver, we're talking about an additional 600 million ounces of annual silver demand just from solar. That's more than 60% of current total annual silver production. Where is that silver going to come from? That's the question nobody has a good answer for. You can't just flip a switch and produce more silver. The mines that exist are already producing at capacity. New mines take a decade to develop. Recycling can only provide so much. At some point, price has to rise to either ration demand or incentivize new supply. And given the timeline constraints, price is going to have to rise significantly. Now, let's talk about what's happening in the derivatives market, because this is where things get really fascinating. The COMEX silver futures market has been the primary mechanism for price discovery in silver for decades. But there's been a growing disconnect between the paper market and the physical market. In September 2025, we saw something unusual. A large number of futures contracts stood for delivery instead of being rolled forward or cash settled. This forced the COMEX to actually deliver physical silver. And while they were able to meet those delivery demands, it put stress on the system. Registered inventory dropped sharply. What this tells us is that some sophisticated players are starting to call the bluff of the paper market. They're saying, I don't want cash settlement, I want the actual metal. And when that happens at scale, when enough contracts stand for delivery, the paper market loses its ability to suppress price through unlimited contract creation. There's a historical precedent for this. In the late 1990s, the London gold pool collapsed when too many holders of gold certificates demanded physical delivery. The price of gold, which had been suppressed for years, broke free and began a multi-year bull market. We could be seeing the early stages of a similar dynamic in silver. And here's something that should concern anyone who thinks silver is just going to quietly consolidate at current levels. The technical setup on the charts is incredibly bullish. We've got a multi-year breakout, we've got a golden cross where the 50-day moving average crossed above the 200-day moving average, and we've got momentum indicators showing strength, not exhaustion. When you combine bullish technicals with bullish fundamentals, that's when you get sustained moves. One without the other can lead to false breakouts or unsustainable rallies. But when both align, you get the kind of move that defines a market cycle. Let me tell you about what happened in 2008, because there are some interesting parallels. In the summer of 2008, silver was trading around $18 an ounce. Then the financial crisis hit, and silver got crushed along with everything else, dropping to $9 by November. But here's what's important. By 2011, silver had rallied all the way to $49. It didn't just recover, it nearly quintupled. Why? Because the response to the financial crisis was massive monetary expansion. The Federal Reserve and other central banks printed trillions of dollars. And investors, recognizing that this would debase currencies, piled into hard assets like gold and silver. Now look at what's happened since 2020. We've seen monetary expansion that makes 2008 look modest. The M2 money supply in the United States increased by over 40% between 2020 and 2022. That's an unprecedented expansion of the money supply in peacetime. And while the Fed has tried to tighten since then, the money that was created doesn't just disappear. All of that liquidity is still sloshing around in the system. And as it works its way through the economy, it shows up as inflation, not just in consumer prices, but in asset prices, real estate, stocks, and yes, commodities like silver. But here's where the current situation is different from 2008 and potentially more bullish for silver. Back then, the industrial demand story for silver was much weaker. Solar was a tiny industry. Electric vehicles barely existed. 5G wasn't even a concept. Today, all of those industries are massive and growing. So you've got the monetary debasement story plus a structural industrial demand story. That's a powerful combination. There's also something happening in the mining sector that's worth paying attention to. Several major silver mining companies have been acquired or taken private over the past 2 years. When companies get taken private, it's often because sophisticated investors believe the public market is undervaluing the assets. They're willing to pay a premium to take control because they see value that the market isn't recognizing. What does that tell you? It tells you that people with deep knowledge of the silver industry, people who understand the geology, the economics, and the market dynamics, believe silver assets are undervalued at current prices. They're putting billions of dollars behind that belief. And let's talk about what's happening with silver ETFs, because this is another piece of the puzzle. The largest silver ETF, SLV, has seen steady inflows over the past 6 months. Not massive inflows like we saw in 2020, but consistent, steady accumulation. That suggests institutional interest is building. But here's what's really interesting. The smaller, physically backed silver funds like PSLV have seen even stronger inflows relative to their size. PSLV is different from SLV because it's structured to allow investors to take physical delivery of the silver. The fact that investors are choosing PSLV over SLV suggests they want exposure to physical metal, not just paper claims. This preference for physical exposure is showing up in other ways too. Sovereign mints around the world are reporting record sales of silver coins. The Perth Mint in Australia, the Austrian Mint, the Royal Mint in the UK, they're all seeing surging demand. This is retail investors voting with their wallets, saying they want to own physical silver. Now, I want to address something that skeptics often bring up. They'll say, silver has had false breakouts before. What makes this time different? It's a fair question, and it deserves a serious answer. What makes this different is the convergence of multiple bullish factors that haven't all been present at the same time before. You've got technical breakout. You've got supply constraints. You've got surging industrial demand. You've got monetary debasement. You've got geopolitical shifts away from the dollar. And you've got growing investor recognition of silver's role in the energy transition. In previous rallies, you might have had 2 or 3 of these factors, but all of them at once? That's rare. And when you get that kind of alignment, the moves tend to be larger and more sustained than people expect. There's also the psychological factor. Silver has been in a bear market or consolidation for so long that most investors have given up on it. It's been the metal that's always about to break out, but never quite does. That skepticism, that lack of belief, is actually bullish, because it means the market isn't crowded. There isn't excessive speculation. When the move really gets going, there's a huge pool of skeptical investors who will eventually capitulate and buy. Let me give you another historical example. In the late 1990s, gold was in a brutal bear market. It had been declining for nearly 2 decades. Everyone had given up on it. The UK sold half its gold reserves at the bottom. That's when the bull market started. Gold went from $250 to $1,900 over the next 12 years. Silver is in a similar position now. It's been frustrating investors for years. The skepticism is thick, and that's exactly the kind of environment where major bull markets are born. Now let's talk about what could derail this thesis, because it's important to consider the risks. The biggest risk to silver would be a deflationary collapse where industrial demand craters. If the global economy went into a severe recession and solar installations, EV production, and infrastructure spending all collapsed, that would hurt silver demand. But here's the thing. Even in that scenario, silver's monetary properties would likely support the price. We saw this in 2008. Silver initially fell with the market, but it recovered quickly as investors sought safe havens. And given the amount of monetary stimulus that would inevitably follow any major economic crisis, silver would likely benefit on the back end. The other risk is that somehow, miraculously, new silver supply comes online quickly. But as I mentioned earlier, that's not how mining works. You can't just decide to produce more silver and have it happen in 6 months. The lead times are measured in years, not months. There's also the possibility that some technological breakthrough reduces silver usage in solar panels or other applications. But even if that happened, it would take years to implement at scale. And meanwhile, new applications for silver keep emerging. Silver's antimicrobial properties are being used in medical applications. Its conductivity makes it essential for advanced electronics. The demand story has multiple legs. So when you weigh the risks against the potential rewards, the risk-reward ratio looks extremely favorable. You're not buying silver at $50 after a massive run-up. You're buying it at $33 after a multi-year consolidation with a technical breakout confirmed, and with fundamental drivers that are only getting stronger. Here's what I think happens over the next 12 to 24 months. Silver consolidates its breakout above $32, probably testing that level as support a few times. Then, as the industrial demand story becomes more widely recognized, and as the supply constraints become more apparent, silver begins a sustained move higher. The first target is $40. That's a psychologically important level and represents about a 20% gain from current levels. But I don't think it stops there. If the gold-silver ratio compresses to its historical average, and if gold continues its current trajectory, silver could easily reach $60 to $70. That's not a prediction, it's a mathematical possibility based on historical relationships. And if we get a real mania phase, the kind of thing we saw in 2011 or 1980, silver could go much higher. I'm not saying that will happen. Manias are by definition unpredictable, but the setup is there for something significant. What should you do with this information? That's ultimately your decision. But I'll tell you what I'm seeing from sophisticated investors. They're accumulating physical silver, not as a trade, but as a long-term position. They're buying on dips, they're dollar cost averaging, and they're thinking in terms of years, not months. They're also looking at silver mining stocks, which offer leveraged exposure to silver prices. When silver moves up 50%, a well-run silver miner's stock might move up 150% or more because of operating leverage. But that comes with additional risks, so it's not for everyone. The key is to have a plan. Decide what percentage of your portfolio makes sense for silver exposure based on your risk tolerance and investment goals. Don't bet the farm on any single asset, no matter how compelling the story. But don't ignore an opportunity like this either. Because here's the reality. Opportunities like this, where you have a clear technical breakout, strong fundamentals, and a market that's still skeptical, they don't come around often. Maybe once or twice a decade. And the people who recognize them early and act on them are the ones who build significant wealth. Silver's bull run has activated. The breakout is confirmed. The fundamentals are aligned. The question is, what are you going to do about it? Are you going to wait until silver is at $50 and everyone is talking about it? Or are you going to position yourself now while the opportunity is still in front of you? The choice is yours. But don't say you weren't warned. Because when silver really gets moving, when it captures the attention of the mainstream investment world, it's going to move fast. And by then, the easy money will have already been made.